Hey everybody, welcome to no, it's not week bajillion according to Adam like last week. I did listen to the recording, by the way, and this is actually week 220. And actually, it wasn't my 35th or my 40th wedding anniversary. It was the 41st, and it was actually this week, but we took the week off. So we were down in Kiowa. That was a ton of fun. And I played it for my wife, Adam, and she just thought that was hilarious, your commentary. So there you go. Hey, everybody, welcome. Yeah, we're going to talk about the 5 dumbest and maybe even more tax blunders that business owners make. And Adam was coming in hot, so we wondered, like, is he going to make it? You know, because he's always on time. But we thought, what would we do? So Jack and I actually have seen some tax mistakes that business owners have made. So we might just add into the fray. So before we do that, though, Adam, you may have a riff. And then I know, Jack, you've got an update from some legislation that is important, that it pertains to everybody. Just a reminder, if you got questions, hit us with the Q&A and you can harass us in the chat. All right.
Yeah. No, the riff before I then riff on Jack and what he's going to talk about, I'm assuming, is that you're starting to see some policy proposals out of the Harris campaign. I hear she's leaning into Kamala, but I've been lectured that, I don't call Trump Donald, I don't call Biden Joe.
Yeah.
I didn't call Obama Barack, so I probably like. But yeah, we call, there's Beyonce, there's Oprah, you know,
Yeah.
there's
Dr.
there's
Phil.
J-Lo, there's Gaga, like there is good, um women first name things that I could see her leaning into. But anyway, she started releasing some proposals, and from the tax standpoint, outside of the no tax on tips thing, which I don't, maybe that'll go somewhere, maybe it won't. I mean, the problem with the no tax on tips for tipped workers is that then you start getting into a parity problem of like, well, look, if I make, $40,000 over here and I don't have to pay tax, and I make $40,000 over here and I do have to pay taxes, how is any of that fair? So I don't know, that's going to go anywhere, and it wouldn't impact a lot of our clients anyway, other than restaurant owners, because then they would, the result of that would be, then why would I have a FICA tip credit anymore? If I'm not paying tax on tips, because the whole incentive there is to report your tips, pay taxes on it, and the employers get credit for it. Anyway, to get to the punchline here, because Jack's like, beat it up, he's actually stall for time. I still need to look at this non-compete thing. Their proposal, what she's proposing, pretty much is the Biden tax plan, which, long story short, is don't reverse the Tax Cuts and Jobs Act per se, but rather, take the C corporation rate from 21%, which is what it went into with the Tax Cuts and Jobs Act, up to 28%. So it wouldn't be at 35%, which is what it was, but take it up to 28%, and then phase out the Tax Cuts and Jobs Act, but target people that they consider high income earners for that, which is anybody making over 400 million. So that's the one where I feel like I think we have to plan on, probably there will be some movement on doing something about the Tax Cuts and Jobs Act, and not just making everything permanent exactly the way that it is. Regardless, in other words, unless there's a Republican administration, Republican House, and Republican Senate, and they all happen to agree. So that I would caveat that second statement. They all happen to agree, because if we remember, we had super bipartisan tax legislation on the House side, which the Republicans control, that did not pass the Senate because of Senate Republicans. So the implication that everybody can agree on everything, don't take that to the bank. So I think we have to assume there probably will be some changes to Tax Cuts and Jobs Act. If I'm prognosticating, pulling what is it, the Great Karnak, Gary?
Yeah, it's the Great Karnak.
Yeah, if I'm pulling the Great Karnak, I think what will end up happening is the tax rates will probably go up about 8 to 10%, based on all the adjustments, one way or the other. Uh, but the phase in probably won't be 400 grand. I think it's more likely the phase in will go up to maybe 1 million to 2 million of adjusted gross income. Just because I feel like, 400 grand is a somewhat arbitrary line in the sand that still hits a lot of people. That I know it sounds like a lot, but a lot of us would say, hey, I mean, when the average house price in Charlotte is, whatever it is, $280,000 now. I mean, it's either 280 or like 325. 400 grand is not that much money anymore. From that's a basic 2 income family now these days. So I think they'll probably raise that limitation up, which won't impact revenue that much if they were to raise it up to 2 million bucks in terms of the intake for the government. But in terms of the taxpayers that it would move from the equation, it would go from like a lot to very targeted and very few. Um, I have had some clients that have said, hey, the tax policy center, which is one of my favorite sites, too, by the way, but they estimate that there could possibly be a GDP slowdown and some job losses if tax rates went up. Um, that could be that could be true. What I would say to that is that adjustments downward are temporary, just like any adjustment up due to a rate reduction is also temporary, meaning like all changes that they make to the tax code end up being real short in duration relative to like long-term sustainable. Hey, this made a super big difference. So, that's my best guess as to what will happen. I mean, it's kind of as we suspected. But I guess my other riff on it, Jack, I'm hoping you can help out on this one, because I think you're going to talk about non-competes, which we're excited about, is your riff. And as I was thinking about, well, what would I say about non-competes? I think if you could sort of editorialize, why would a regulatory body come out and say something versus just letting the courts decide, which is what has historically happened with non-competes? Because I mean, I think from the employer's perspective, I think we were all kind of thinking that non-competes had become pretty much worthless anyway. In terms of like how unrestricted they actually were, relative to most of the court cases in the last couple of years, at least in the legal circles we're running in, which you're one of them, Jack. So I kind of looked at it as like, well, I mean, that seemed like a regulation that didn't really mean a whole freaking lot, relatively speaking. So go.
Yeah, absolutely. I think the reason why non-competes have become useless in that perspective is because it costs money to enforce them. So, assuming that they're enforceable, and we've talked about the two kind of general parameters, that it has to be reasonable in geography. So the physical geography of where you cannot do the thing that you were doing, and then also the time, whether it's 1 year, 2 years, 5 years, forever, which obviously is not enforceable. And so you have employers who have these rights, at least currently, but need to incur the cost of enforcing it. So filing a lawsuit. And then at the end of the day, what do you get? You get a piece of paper maybe that says you are correct. And so this person cannot do these things. You might be able to get some money from them, but are they really going to be able to pay the money, the damages? So really, a lot of times it is more to prevent others from competing, or at least having that in the back of their minds. Because you might imagine the scenario where we get a lot of employers who say, hey, look, I have this person who has violated my the restrictive covenants that are in all of my employees' agreements. On the other side of it, you have employees that are coming to me and saying, well, I want to go work for this other company. It's awesome. It's what I've always wanted to do. And I signed this because I had to. And do I have to abide by it? And so you analyze, you go into, well, regardless of whether the first response is, regardless of whether it is valid or not, you may have an employer who is going to make you spend money on attorney's fees, potentially, may also sue your current employer, your new employer, for tortious interference. So you have these various competing interests. So, that's where I think the low value comes into the conversation. It's interesting as all of this has evolved over the course of time in recent months, those differing perspectives, and having employers come to me, whether it is for an employee or if it's, let's say it's a buyer of a business or a seller of a business. So you need to kind of keep in mind those are two different things, and they're actually in this proposed regulation treated differently. So in the context of an employer-employee relationship, and we'll go through what the proposal was that has been put on hold by a federal district court, thankfully, and what many of us thought was going to happen, but not sure if it was going to happen before the September 4th implementation effective date of the regulation. So you have, let's start with the sell of a business. As we've discussed previously, you are a buyer and you are buying this business, and you do not want the seller, who you're paying many millions of dollars to be able to open up a shop next door, down the block, down the road, in another county, in the same state, whatever the restrictions are of the geography of the business that you're buying. And so, for someone to come and say, a regulatory body to come and say, well, those are going to be invalid, that's not what they're saying. They're saying that those are still going to be valid in place, because that was a big concern of employers, I'm sorry, of buyers. That's like, why would I pay all this money if there's just no value in that? And then you start getting into attacking the blue sky value, meaning the intangible value that is allocated to things like the non-compete, to the reputation of the company and things like that. So the purchase price starts reducing, even though, but you're not getting the benefit of holding someone down. So that's off the table. So what the focus is on the employer-employee relationship. And if you remember from previous discussion, the proposal was that moving forward after the effective date, non-competes are invalid as between employers and employees. Now there's some exceptions, and that meaning new ones, putting them in a contract moving forward, that is unenforceable. The ones that are already in place become unenforceable. So again, you go to someone who, let's say you paid severance to, and part of the severance was, I don't want you to go to work for someone else because we're about to launch a product or bring on a new service line, and you have knowledge of that. We don't want you to take that technology to a competitor. So if we bench you for 1 year and give you severance in exchange for you being benched, in exchange for release and all those other things. And so, all that stuff gets invalidated. You cannot say, well, it was not for the non-compete. The compensation was for the true severance, and with the non-compete on the side. So all that becomes invalid. And then the icing on the cake is that you have to go to, as an employer, or you have to go to those employees who have signed non-compete agreements or restrictive covenants within their employment agreement or a separate agreement, and go back to them and say, yeah, by the way, that's unenforceable. So hopefully you don't quit and go open up shop next door, but I need to let you know the federal law now mandates me to tell you that I have to tell you that you can go compete next door if you want to.
Yeah.
There are some exceptions to that with high paid individuals, executives, and so there's numerics that are associated with that. But that is essentially what the rule was proposed to be. And so what happened last week was, and I'm going to pull this up so I don't mangle the message, but so it was August, oh gosh, it was 2 days ago. I thought it was last week. This week, on the 20th, there's a district court in Texas, and that was the court that had a limited temporary injunction, preliminary injunction, temporary restraining order, and granted summary judgment to the parties. And so that is basically just kind of like a screeching halt in the judicial process of enforcement of anything or taking any action. It's just a stop. And so what happened is that that court then, in further hearings, held that it was the final rule by the FTC was invalidated on two grounds, and it's things that we talked about, that we thought about what was going to happen last week and prior weeks, which is the FTC lacked the authority to issue the final rule, so they had no authority to even do it, and the rule was arbitrary and capricious, meaning it has no basis or reasonable basis grounded in law, authority, etc. They didn't, I don't think they got into kind of the constitutional issues that we had discussed previously about that those rights are reserved to, I mean, they sort of did, but they didn't, I don't think they got as specific as they might otherwise down the road. And so the FTC has indicated this is not the end of the story, that they will likely appeal that. But the good news is that you can, with other things, it was limited to the people that were pursuing the action. So it was only limited to, like, for example, with the Corporate Transparency Act, which we will in the very near future go through that again, because it seems like it's not going to go away anytime soon, and that it's going to be enforced. So that's a topic for another day. But in the instance where there was a lawsuit filed and the court said, put on the brakes, stop, it's only applicable to those people that were involved in that lawsuit, and it was an industry group. In this instance, the stop applies to everyone in the United States. Now, I do not personally know why there is a difference between the two. I can ask one of my litigators, and I'm sure they would be able to tell me, but just know that the biggest news out of all of this is that the September 4th deadline is no longer a deadline looming over everyone that has in causing any business owner to have to do anything at this point, including going to their employees and saying, yeah, you can do whatever you want. And you can continue to put those in agreements. I mean, it was our intention to not stop putting those things in agreements, because you never know what's going to happen. But, maybe being a little more careful as to what, trying to pull that out into a separate place in the agreement, so that way it can be removed at some point without invalidating the rest. So little tactics like that. But that's the big news, is that, as we kind of expected, but was not expecting it to happen this week. I was thinking it's going to take them a month to get through. They're going to have to brief the court. They're going to have to go through all this. They probably want to hear from people on both sides of it. So that's where we're at. So I don't want to take up any more time talking about it, but that's the big update.
Well, it's encouraging.
Yeah,
common sense prevailed.
Yeah, I thought you were also going to tell me, Jack, that the other really good news is that, based on the advice of legal counsel, when I was supposed to give people consideration for those non-compete agreements, I can go get my money back. Is that what you're telling me too? Like, I can go back and get the money that I paid all the people for the non-competes? That's great.
Yeah. The ticket? Sure. You didn't hear that from us, so good luck with that. Let me know how that goes.
Yeah, let me know how that goes. Yeah, I'm gonna need to take that 10 grand back from you. Yeah, that's funny. Yeah, so you ready to hop into top mistakes, Gary?
Well, so the first one, Jack has one and I've got one before you dive into the other ones. So Jack, what's yours?
It was, make sure your social security numbers and your spouse's social security numbers are correctly stated on your front page of your 1040 tax return.
Oh, that's a good one. So
Yes.
another one that I've seen is you just failed to file your tax returns. So
Did I do
And,
that?
and then Adam joined the conversation and saved
yeah.
all.
Yeah, it's like you're right. Those are some very basic ones. Like, you do need to actually get up out of bed in the morning, and put on, pants. Yeah. Anyway, yeah. So, thanks. The top five mistakes that we see, uh, and these are actually kind of not necessarily rank ordered in terms of severity of the pain and the damage they cause. Although, they are correlated, but rather how frequently we see them. So the first one, and you've heard us harp on this webinar before about, keeping the corporate formality. And what we really mean in terms of keeping the corporate formality is keep business business and personal as personal. Now, if you're talking to Adam, not Jack, but if you're talking to Adam and you're saying, hey, just asking for a friend, aren't there some expenses that I really can make the case for business? Yeah, but keep them in the business, not personal. So a lot of people on the call are going to say, does not apply to me. My corporate records are pretty clean. I should be, I should be good. Meaning like, there's no mortgage payment commingled, with the with the whatever, right? So I think that's probably a true statement for a lot of our clients. So in terms of the commingling of business records, that really most often, you see some big companies, it's like, you get the call from the fired up controller who thinks they're going to go to jail. Man, they're using this company as their personal piggy bank, and what we find is like, it's not that bad, typically like a lot of times these are fringe benefits that we think are allowable and deductible, but sometimes they're not. So we usually can get those cleaned up. So it's usually small companies that have the problem with the corporate formality. The meaning, below $1 million in revenue, first couple of years of startup, whatever, it's like, I know I need to set up a company bank account and get a company credit card, but it's just easier for me to do this for right now. Well, when I say new companies, what we also find is that, hey, part of one of our tax minimization strategies is, some of our clients have very large companies that then decide to buy, beach properties, that they're going to VRBO. They start up, they buy a piece of commercial property, they buy a luxury yacht, Gary, and then deduct that, that, and then they just forget all thoughts of record keeping goes out the window. So it just, that, and if you think about like, well, what problems does that cause? First off, if you're not keeping track of the records of the deductions that we're trying to create in the first place on these side hustles that you're starting, it sort of negates the whole value of the tax deduction in the first place. In other words, if you buy the place at the beach and you're going to rent it out, and I tell you, the great thing about that is when you're at Ocean Isle Beach, and you're working on the working on the house, and you go out to eat at Sharky's, that could be considered a deductible meal. Like, oh, okay, great. And then I put it on my personal card, and then I just forget. Like I forget to go back and account for it. So then tax time comes, like, that's too much of a hassle. Okay, maybe for like one $50 meal, but when I've got 20 of those, I mean, all of a sudden stuff starts adding up into real money. So that's problem number one. Problem number two is, if you get audited, then they're going to say, hey, we'd like to see the bank records. It's just a lot better if I can say all that is business versus, well, that one is, but that one isn't. Well, explain to me why that one is, but that one isn't. Explain to me why this Lowe's receipt, was business, but this Lowe's receipt in the same account one day later was not business, right? So it just makes life a lot simpler. So that's really number one is keeping the record keeping clean. And I'm not talking about like not be aggressive. I'm talking about be aggressive, but in the business account. And then let the professionals call the balls and the strikes, versus being either lazy or calling your own balls and strikes. So that's number one. And if you think about it, it's like without trying very hard, I can usually find between 20 and 50 grand in owner fringe benefits annually that people are not deducting that they could deduct. You multiply that times tax rate of 30%, that's a lot of money. In other words, like if I walked up and said, hey, here's 6 grand or 10 grand, you probably would take it, right, Jack? Yeah. And if I said all you got to do is open up another bank account and this money's yours, you'd say, sweet, when can I get started? So that's really number one. Number two that causes a lot of damage is around what should I, as the business owner, pay myself? Because people hear the term reason, as a business owner, you gotta take a paycheck. I'm talking specifically around S corporations and C corporations right now. I'll get to partnerships here in a second, but S corporations, C corporations. Hey, you own the company. You gotta take a reasonable wage. Reasonable. So then you go Google reasonable and IRS. You ask my BFF, Chat GPT, what's reasonable? And you're not going to get any definition in any sort of written format that you can say, let's count on that as authoritative source.
If I could interrupt, that's probably one of the top 5 words that is argued over or negotiated in an agreement. Because no one really knows what reasonable is. I mean, it means something more than arbitrary, but what does that mean?
Right. And I actually, it's funny, I'm saying I don't know what ChatGPT would tell me. But someone can probably try this on the call and say, hey, Adam, actually it kind of nailed it, based on what you said. I haven't actually tried the question. I'm assuming it doesn't work. I'm going to try it after the call, but let's assume you can't find the definition, right? So, the problem, just remember the problem we're trying to solve for here is that every dollar that I take in a W-2 has Social Security taxes on it. And it also is taxed at a higher tax rate than every dollar that I take as a dividend or a distribution. So it's like, I obviously would rather take the low tax rate stuff if I can, all of it, right? So, but I can't do that. I've got to take some form of reasonable compensation. So the first big problem that we see is, they come to us and the company has $100,000 loss. Like, well, that sucks. Your company's losing the money. We need to figure out how to get you to make money. And then you look at, well, what did the owner pay themselves? And the owner paid themselves 200 grand. So 100 of the lost money was due to the money that they paid themselves. That is insane. Because even though they've got, a loss in the business to offset the taxes that they paid on the W-2, I still had the Social Security tax. Like that was completely unavoidable, unnecessary, not going to go to jail if you'd have dialed that wage back. So that's right out of the gate. That's insane. That to pay yourself a wage to then create a tax loss in your business, insane. Don't ever do that. The second thing that we see that's pretty common though is a scenario where same set of facts, company makes 20 grand and the owner paid themselves $200,000. It's like, now you're giving me something I can work with a loss situation too, but now you're really giving me something to work with. Because, in that scenario, I have the ability to convert some of that wage over to a distribution and have it be at a lower tax rate. Now, somebody can get on their high horse for a minute and say, but Jack, am I not worth $200,000? In fact, I'm worth 400, but I'm only paying myself. Well, not today. Otherwise, you'd be able to pay yourself 400, right? So I can argue you're not really. So in that scenario, you need to fall back more. And I'm not saying you're not worth 400 grand. You shouldn't be pushing for 400 grand. But once you're making money, our position is you need to revert quickly back to what can I get away with? So what I can get away with in that scenario is anywhere from a ratio of 30%. I mean, you could be 100%, but 30% really is the low demarcation line. 50% is right down the middle of the fairway. 30%, Gary, I'm going to get a little aggressive, swing a little harder and try to draw the ball, get a little extra distance out of it. 50% is straight out of the fairway. So off $220,000 of pre-W2 earnings, right down the middle, 110 wage, 110 distributions, that guy just saved 15 grand or gal just saved 15 grand by making numbers, without any sort of concern, that's going to get raised upon audit examination. So you always get a dumb question at this point, Jack, which will be something like, well, but what if I had been paying myself? Isn't it going to raise red flags if I lower the wage? I've never heard of that. And I would rather argue than not. You have your hand up?
Yeah, just a point of clarification as I was choking on my coffee as you said this. It's not that, I think that it's more of, again, back to what is reasonable, not what you can get away with. So when you say what you can get away with, you mean what is reasonable,
Yeah.
given what you're doing for the company and what you would be paid for in the market as if you were working for someone else, is I think maybe sort of what you meant.
That
I'm just messing with you. You don't have to defend.
No, it's actually pretty funny because that you say that because one of the tax court cases. So then you start getting in. Thank you for asking that. Evidently, we're not going to have a part 2 of the top 5 dumbest tax mistakes after we get into the top 5 dumbest legal mistakes part 2. But because we're going to spend the rest of this conversation on reasonable compensation, debating between the guy who actually has the law degree versus the guy who just wishes that he had the law degree. But one of the more famous court cases that's out there on the discussion of reasonable compensation in an S corporation, actually, shockingly, is my profession, the CPA firm, and shockingly is my exact role. Right? So, and he was kind of in that 30%, 70% range that I just referenced in terms of what can I get away with. So that is right. Go back to Jack's definition, what's reasonable. So one can make the argument that my role is worth $400,000 servicing clients and managing people, right? So like I make that argument, At the same time, if I look at my time, and that's not actually what I'm doing, I've got 50 chargeable client hours. Okay, that's not much of my time. I really only have 100 hours of people management. That's not much of my time. So basically, what am I doing? I'm out, talking to my banker. I'm out talking to a few key customers, playing golf all the time. In other words, I'm retaining ownership. I'm in the role of managing partner, but I'm not actually doing managing partner things. The guy won the court case because his argument was, look, I mean, out of a 2,000 hour year, I only spent 600 hours actually working in the business. The rest of the time, I was there, but look at my time. I wasn't really doing anything, you know? So really that time should have been associated with maintaining my investments, you know, which is the 70% of the distribution, and he won, you know? So because he could prove that I really wasn't spending a lot of time actually doing stuff that you can find reasonable compensation surveys for. What I was spending my time on was managing my investment, which is really where you're hanging your hat, you know, on what am I, you know, I'm actually managing my investment. So is it okay if I continue on my tirade, Jack?
Yeah.
All right. He's like, you're still full of shit. So then you get into what's sort of the upper limit. So now I made, $3 million. I'm killing it now. What's the upper limit? Surely we're killing it, Jack, at that point. What's the upper limit? Well, if you kept with the kind of keep it down the middle of the fairway argument, and now I'm just going to split the difference, $1.5 million and $1.5 million, like that is an argument. But if I was to say, well, look, how many people have you worked at Bank of America, Gary? How many people make $1.5 million at Bank of America?
Those on the top floor.
Yeah, not many. Out of 100 and some odd thousand organization, not many.
Yeah, it's 320,000 people now.
320,000 people, not many, right? So it's like
very small
So
handful.
in other words, is $1.5 million really reasonable? No, it's not, because if I had to hire somebody off the street because I wanted to go play golf in Palm Beach, I wouldn't pay him $1.5 million. I'd probably pay him like $250 plus some sort of incentive compensation, right? So it's like, all right, so you've already ruled out the 50-50 argument out of the equation. And now we truly are just reflecting on what's the upper limit of reason. Well, the other end of the spectrum would be, well, you at least need to pay yourself Social Security wage, which is $170,000, $180,000. You ought to consider bumping that up to be able to maximize your 401k, which is going to bring you up to about 330. But then if you really want to hang your hat on what's truly fair and reasonable, this is still true in Japan. It's not really true in the US anymore. Gary's going to make an argument around, well, I mean, look at their economy, Adam. Of course we should be doing what we're doing in the US. I don't know. I'm just saying, like, at some point somebody said CEO pay should be no more than 10 times the annual worker pay as a good ratio of like good corporate stewardship and governance, and getting everybody rowing in the same direction for longer term results. That kind of gets you back to, take the current minimum wage level that's going into place, $68,000, multiply times 10, that's $680,000. That I would die on the hill all day long, in terms of that being my upper range of reasonable. Another data point would be, let's say that I'm selling the company. I'm sure Jack's never heard this before, in terms of representing buyers and sellers. So Jack's representing the seller, and he's got the investment banker who's a complete jackass who adds back 100% of the owner's salary back as an add back to EBITDA. He's like, Jack, I don't know if anybody can see Jack on the camera right now, but he's laughing because, like, yeah, actually I've heard that before. So 100% of it, because this place runs itself, right? How many transactions have you been a part of, Jack, where a 100% add back of the seller salary survives?
I mean, it's always attempted, but I mean, it is the person. Well, I look at it as, if not for this person, you'd have some outsider, a hired gun, and you'd be paying that person, right? So it's, you can't just say, well, like, I mean, you said it, the company runs itself. Yeah, not so.
Yeah, right. So there's always, so in other words, so then you say, well, then what does private equity say? So like in that scenario, what have you this is one that you will not lose the law degree or be disbarred for, Jack, I'm pretty sure. But in terms of, even if you're representing the buyer or you're still representing the seller and you happen to be a party to that discussion, we're going for 100% add back. Buyer pushes back and says, no, that's BS. There's going to be some sort of add back for reasonable compensation. What's kind of the relevant range that you've seen?
I mean, well, it depends on which side you're representing, right? But mostly you end up with kind of the analysis, which is what would your replacement, what would be the reasonable cost to include in that? And it may be, depending again on which side you're on, is it even more than that? Because it is, you might, as an owner, might do it for less than what you might have to do, either replacement value or the replacement cost. From the other perspective, it is, well, a professional in my position would be more efficient, so it'd be less cost and we can pay someone less than what I'm taking out of the company. So it really just depends, but you end up usually with hopefully a reasonable number that is agreeable to both. So that way you can move on from that issue.
Yeah. Have you ever seen it be more than 500 grand?
Is that a trick question?
Yeah,
Are people not important enough to be paid $500,000?
I'm just saying, if you have in any transaction, have you ever seen it be more than $500,000?
No.
Yeah. So my point in saying that is that, and yet another data point that I would die on the hill for is that between the collective transactions that Jack and I have seen, we have not seen a private equity company which has a strong incentive to argue for the highest CEO compensation possible in order to reduce your purchase price, which has a multiple. So that 500,000, that's $5 million adjustment, $3.5 million adjustment. It's a big adjustment. Like the best in the business, aren't arguing for $1.5 million is reasonable compensation. They're not arguing for 750 is reasonable compensation. Like, if I'm thinking through like the transactions I've seen, usually it's about 250 to 400, it's kind of the range of what I've seen private equity try to argue is reasonable compensation for CEO replacement. I mean, is that kind of the range you typically seen, Jack?
Yeah, and I would say some of the arguments also get into the non-monetary compensation. So the payment for that house in Maine where the owner goes to, do his or her business development. And so that is, is that a business expense or is that compensation because it happens to be a mansion that he or she brings all their grandkids to? So you start getting into outside of core compensation. But yeah, the point is that it is an exponential effect when you start shifting numbers because of the multiple, because of the expectations of purchase price, and just formulaically.
Yeah. So again, you go back to, every dollar that you can shift is, and anywhere between 20 and 30 cents that you're going to put back in your pocket, for every dollar that you can shift over. So it's worth looking at. And as I said, Gary and I see a lot of people that take a very conservative approach. Yeah. And I think what we're trying to communicate here is that even if you were to take the most conservative approach, it would be extremely hard to argue anything more than $500,000. In terms of a rate. There may be other reasons that you do that are not part of the scope of the discussion, but if you're simply talking about avoiding paying too much in taxes, there's your strike. There's your window, in terms of your strike zone.
And just to glom onto that, one thing that we've seen repeatedly with really high owners and entrepreneurs that had typical CPA advice, it was like half, which we've seen like, well, that's not necessarily what is required, and based on what you just said. Now, the Starbucks new CEO at 113 million, while they're paying their baristas 49,000 is the average. That, a conservative CPA would say, oh, well, you're going to have to pay, about 60, not quite, but 55 million in W2. That would be a conservative CPA. Oh my gosh, the world is upside down on some of this. But anyway, yeah, you make a great point on both of those, Adam. Keep going.
Yeah. All right. So number
Three.
three. Three, one, two, three.
Three.
Starbucks gift card forever can say what show that's from.
Well, you gotta do the laugh though. You can't do that without doing the end laugh. Thank
Yeah,
you.
yeah. Number three is dude, count on Jim. Yeah, way to go, Jim. Good job. He's actually watching it on a second monitor right now. Yeah, it kind of says it all right. Just decent Jim. The third thing that we see that's pretty often or pretty common, and again, this gets a little bit wonky, but it's the broad topic of method of accounting, which is how I look at my financial statements internally is not necessarily the same way that I have to report them on my tax return. So the most common example of that is, I keep my books on a true traditional accounting basis, which buzzword is accrual, meaning like as I earn the money, versus like when I actually collect cash and pay bills, which is the cash basis. So accrual basis, I bill Jack, I recognize that as a sell, even if Jack hasn't paid me. Cash basis, I bill Jack, but I don't actually recognize the sell until Jack pays me. So the IRS, a long time ago realized, well, I could employ, people could employ the strategy of just not, accepting payments towards the end of the year and avoiding, paying taxes on stuff. So they put some parameters around how big you can be before, no matter what, you have to be accrual basis. So being a cash basis taxpayer, especially when you're a high growth company, huge tax advantage because I'm not paying taxes on money that I haven't collected. So that's more money that I can keep in the company to finance my growth instead of using the bank. I mean, if I've got millions of dollars in outstanding receivables, would I rather pay a $600,000 tax bill today, or would I rather kick the can on that $600,000 tax bill to a year and a half from now? Of course, I'm going to pick a year and a half from now, right? So always a great strategy when a company's growing. So it used to be that if you were $10 million, you had to convert with some limited exceptions. There are some companies like mine and Jack, pure service companies have an unlimited exception. Other companies don't. But you had to, so construction companies, example, would not qualify for the exemption. It used to be that it was $10 million. Well, they raised the bar as part of the Tax Cuts and Jobs Act to 25 million. And then it's indexed for inflation. So all of a sudden, there were a lot of people that were in that 10, above 10, below 25 window that just didn't know. Like they had no idea that this was something that they could do. So, all of a sudden, it's like they come on board with BGW. It's like, hey, you're not paying taxes for 2 years, dude. Because you're not going to have to, you're not going to have to worry about what's sitting in your receivables balance because you've already been taxed on it, so good news for you. So that's one. I think the second one that we see too a lot is that under the same rulemaking, there are some certain carve outs where you can immediately expense your inventory as well. So, which is awesome, for people that otherwise were, and it's primarily related to two components. Component number one is, small incidental items of inventory. So like, if I sell a big piece of heavy machinery, and then I've got air filters that I change out on them pretty frequently as part of repairs. It's the air filters piece. So if I've got, $3 million in inventory, maybe this is only $300,000 or $400,000 of stuff that would qualify. But at the same time, that just moved having to pay that tax bill out. I just got you $100,000. I just moved that tax bill out a year and a half by automatically expensing that type of inventory, which is one that people didn't know about. And then the last one related to the inventory change is that for companies that really keep a true proper inventory that are manufacturing stuff. So I've got raw materials that come in. I've got work in process that includes some elements of labor in the work in process. And then I've got finished goods, which absolutely includes labor. I can expense the labor component. Like I don't have to actually have that in my inventory for tax purposes below 25 million bucks. So again, people just didn't know, like they didn't know, because that last one was brand new, like just came out of nowhere. People just didn't know that was a thing that they could do. Which again, you're not permanently saving taxes, but you are deferring them until a place and time of your choosing, which is always a great strategy.
So Adam, just to be clear on that, because we do run into that a lot with new clients that are, in that range. But if I'm not mistaken, it's an average over 3 years. So it's not like, oh, you clicked over this year 25 million, all of a sudden, boom, you're nailed. I think it's a 3-year average, isn't it?
Yeah, it's 3-year period. So the first year, and then you've got 5 years to pick up the tax. So it's like, in other words, like the first year that I pop over, I don't have to convert. It's a 3-year look back. So I actually have a window of time, to get there.
Yeah. Cool. Well, do you have time to do number 4, or do we need to wait until part 2?
I probably would wait for part 2 because the next one gets pretty darn wonky.
Okay. Well, we did cover 5 though, because we had make sure that your social security numbers are right and not transposed, right, and file your taxes. That's number 2. So we'll do the other 3 or 2 in a couple weeks.
That's right.
All right, cool.
And
so next week,
sharing with you, Gary, the link to that client alert to you. I don't have the ability to share it with everyone, so I just sent it to you.
Okay, cool.
Republish it in the last few minutes that we have here.
All right, everybody, I'm going to put this to everyone. Here is the article. Wait a minute. It's wanting to do the wrong one here. So
and we also have, with last week, we didn't get through the entire list of stuff on legal. So at some point, I don't know if we want to do the next one legal and then the next, however you want to schedule it, but just so everyone knows that, there's going to be a part 2 session for both legal and accounting financial stuff, because we just didn't get through it.
Okay, and everybody, before we sign off, if you're interested, grab that link, shoemaker.com, latest thinking publications, deals with this FTC issue. So, all right, good. Well, this has been a good one. Thank you for tuning in. Wish Adam a happy birthday. We ought to be sending him gift cards.
That's right. That's right.
He's in the best shape of his life. And, he's getting 1 year older. So I think that's awesome.
Which is great. I appreciate that. At the same time, have you guys followed Lenny Kravitz at all? That's like either aspirational or demoralizing.
I haven't seen what's he doing.
Oh, dude, just Google Lenny Kravitz, and it's like he's got a good routine going, but at the same time, dude's like 60 something. It's like, good lord, that's insane. You know, the shape that that guy is in. So he's what I'm shooting for, Gary. I've given up on Chris Hemsworth, but I can shoot for Lenny Kravitz.
I like that's a good one. Yeah, Jack LaLanne is still my guy, man.
Yeah, I feel like Jack. I still just I can't get over the
Stretchy
tracks.
pants.
Okay, I just can't, I can't get over the tracks.
Yeah, the stretchy pants are coming back, man.
Sorry.
It's called mid-century modern.
Right.
All right,
Well,
guys.
it's
Have
good that you have, I was gonna say, it's good that you have the discipline because funny, my son got on campus and he went to the rec center, which is, as I said before, a huge upgrade to him working out in the gym in our neighborhood. That and he said, man, it's really crowded in here. I said, you know what? It's like New Year's, the beginning of a school year on campus. It's New Year's, and then give it about a month, and then you'll have the place to yourself.
That's right.
Not as much as like a commercial gym, because I think kids that age are a little more disciplined and they want to stay in shape for
yeah,
various reasons, if nothing else, to stay in shape for the opposite sex, opposite gender, I should say.
yes.
Yeah.
Yeah,
All
there's that going on, that's for sure.
yeah.
All right, well, I'm going to go check out Lenny Kravitz, see what he's up to. The Mason survival guy, he was a Krav Maga guy or something like that. Look him up. He's in the UK and he does everything kind of old school outside, in whether it's raining or whatever. Like, and he's just a carnivore. Like that's all he does is eat meat. But that dude is insane as well. So anyway, oh yeah, Lenny's looking good there. So all right, guys, have a
Right.
have a good week. See
All
you
right,
next
thank
week.
you.
You.
All
Bye.
right, see y'all. Bye.